Hello, everyone. Welcome back to SEC Roundup. My name is Tom Zuccaro, and with me, as always, is Nick Morgan, my partner. Hi, Nick.
Hey, good morning, Tom.
We are going to talk about some recent SEC rules. At the end of December, just before the holidays, the SEC proposed several rules designed to change how the equity markets work and how trades are conducted. We have the honor of our expert today, Nir Kaissar, a Bloomberg columnist. Hi, Nir. How are you?
Hi, Nick. Hi, Tom. Thanks for having me.
Our pleasure. Nick, why don't you just give us a quick summary of two of the rules, one relating to best execution and the other relating to order auctions.
Yeah, absolutely, Tom. So let me back up a little bit. And one of the reasons we asked Nir if he could talk to us today is because you may recall we talked to him about a year ago. And the discussion at that point was the sort of meme stock craze had happened where retail investors had been very active in some company stock that you might not have expected them to be active in. And there was a push for the SEC to look into that and see if something should be done. SEC Chair Gensler at the time was indicating that he had some misgivings about a concept called payment for order flow. So we had noted that Nir had written on that topic and talked to him back then about payment for order flow, what it is, how it benefits retail investors who want to engage in commission-free trading, and the issue about the fact that those trades then get directed toward entities that pay the payment for order flow. And we talked all about those issues. So that was in December of 2021. So flash forward to today, we've got these proposed rules from the SEC, as you say, Tom, that will change the way the equity markets are conducted and these trades are handled. And in my view, the two proposed rules, so they are proposed rules, they are currently open for public comment. The public is able to submit comments up until I think it's March 30th, end of March. So they are not explicitly anti-payment for order flow. In other words, it doesn't ban payment for order flow, but our reading of these proposed rules makes it clear that it makes it hard to do payment for order flow. So for example, in the proposed regulation best execution, there's a concept of conflicted orders, and orders that receive payment for order flow are defined as conflicted. And so if you fall into that type of order, a broker that engages in that has to do a bunch of other compliance related steps. So in other words, you've got two paths, one that involves payment for order flow and one that doesn't. The one that involves payment for order flow is more burdensome. So not a prohibition, just an incentive, a sort of compliance or regulatory incentive that would tend to disincentivize payment for order flow trades. And then you go down to the next proposed rule we're going to talk about, which is the order competition and auctions rule. And you have kind of the same thing there. Orders that are sent to national markets, the exchanges, get sort of treated one way, and orders that don't get treated another way, which again creates an incentive away from payment for order flow. So our interpretation is these rules are designed to make payment for order flow difficult. And so, the public ought to know about that and comment if appropriate.
So, Nir, this commission always talks about the retail investor and improving the retail investors' interaction with the markets. How do you, if these rules are adopted, how do you view their impact on the retail investor?
Well, this proposal is a 400-page plus juggernaut. So your wisdom and your services are going to be needed by a lot of people, I reckon, with this proposal. But and I think Nick's reading is right. I mean, when you look at it, you are struck by the compliance obligations that they're putting on financial firms that are using payment for order flow. And I think anytime you see something like that, this type of proposal, I think it's helpful to take a step back and just ask the point of departure question, the first principles question, which is what are we trying, what is the harm we're trying to prevent here? And I think the answer is we're trying to protect investors ultimately And the question is whether this is going to do that or something different. And one of the things I think that we have to acknowledge about payment for order flow is there is a built-in conflict of interest inside of payment for order flow. And that is because if you are executing through a broker and that broker is turning to a market maker, that market maker in general is turning around and paying the broker for that order flow. That's the payment for order flow mechanic. And that's what allows the broker to not charge retail investors a commission. So there is a conflict of interest embedded there. The question is whether how are we best to deal with that conflict of interest? And I think to sort of before I express that view, I think it's important to sort of understand what payment for order flow has done. By the problem with commission-based trading is that, you know, if you have money and you're making big trades, whatever, a fixed commission is not a big deal. But if you're a small investor and you $5, $10, whatever it is, you know, a commission is going to basically prevent you from trading. But if we're at a point where it's commission free and you can therefore buy fractional shares, and the broker is making money on the flow writ large from all the trades, what that basically means is you've truly democratized the market. Anyone can now participate. And so if you make payment for order flow so onerous, the compliance, which this seemingly does, you make it so onerous that brokers do not want to engage in payment for order flow any longer, then I think the real danger here is that retail investors will no longer have access. You'll go back to the days when you needed to have a certain amount of money to transact. And as a practical matter, that kept out a huge amount of investors. And so what I propose to do about this, I think the way to deal with this is disclosure. We have some data on payment for order flow and its effect. And what that data is showing us is that some of the money on the table, let's call it the difference between the bid and the ask spread. Some of that money is going to the brokers. Some of that money is going to the market makers, but some of that money is also going to investors in the form of better execution than they used to get. And if the SEC had come out instead and said, you know, we're rather than go at this through the compliance lens, we're going to go at this through the disclosure lens and give investors more information about which brokers are giving you the best execution. I think investors would have been smart enough to basically funnel their trading that way. And I was disappointed that the SEC did not go that route, or by and large did not go that route, even though there is a lot of talk of greater disclosure in the proposal. I might add, mostly in the footnotes. I think I counted maybe 50 mentions of disclosure. Maybe 30 of them were in the footnotes. So not in any meaningful way, I don't think.
Yeah. Well, things may change before the rules are finalized. I'm sure there'll be a very active and heavy comment submitted. So we'll wait for the final rule, and Nir will circle back for our third SEC roundup with you and get your thoughts on the final rule when it's finally adopted.
We'll be happy to join you again.
Nir, thank you so much for participating today. Nick, thank you. And we'll see you all back at the next SEC roundup.